Welcome to the Lazy Equity Podcast, where we talk no fluff, just bricks and bucks. Today on the Lazy Equity Podcast, we're going to speak about the setting up of SMSF trust structures and understand a little bit more about what these components do in terms of our portfolio planning and what we can, what we can't do, the nuances around the legalities and the playbook around the finance setups around SMSFs. I'm fortunate enough to have my two co-directors from the Investors Agency join us today, Mark and Justin. Once again, thank you very much, Justin, for coming back again. And Mark, thanks for joining us for the first time.
Thank you. Excited to be here.
Excellent, mate.
Love this topic. Good topic.
Yeah, it is. And it's one that you know quite a lot about.
The godfather of self-managed super funds, so it should be good.
No, I think I just like, there's a lot of things that people don't know about, so just educating them on it. But yeah, great topic.
Yeah, I mean, you've gone through the process quite a few times.
Yes.
Not for only clients, obviously, but also for yourself.
Personally, yes.
Yeah. So I think from that point of view, we really want to try and understand the difficult points along the process that people don't hear about, and really understand a little bit more of what to consider when we're going into that sort of process. Just, you've actually started setting yours up recently, or you already have set one up?
Yeah, definitely. So pretty much in the process of doing all that now as well. So good experience in regards to how to actually continue building your portfolio when you get stuck with your personal name or trust. It's the option that we try to provide to people, is that if you want to keep capitalizing on growing markets, this is a great way to do it. It doesn't take anything away from your personal name or that other situation where you can continue to buy properties at the right time in the right markets and keep moving forward. So
yeah.
I think first up, it's about understanding the setup and the structure and how that kind of plays out. One of the things we see when we're buying for clients in SMSF is that sometimes they get a little bit stressed out because they're not aware of the process, and there's some major differences between buying in your SMSF and your personal.
Yeah.
So I guess it's the size, really having a chat with your accountant, having a chat with your broker and understanding your servicing, working out whether you're going to be buying with your partner or not. So, you may be looking at your super fund and going, well, I'm not sure if I have enough, but you can actually merge your super SMSF funds together.
Yeah.
Create an SMSF bank account and have all the funds in. So if you had 150 each, you'd have a total of 300 and you can manage that together. I think people aren't sure about that. So depending on your strategy there, so speaking to your accountant, getting that SMSF set up and those trusts set up, speaking to your accountant, your broker, and getting good understanding of that type of thing.
Well, with that setup, so you touched on there speaking to your bank as well, your broker, to set that up.
Yeah.
What are the sort of ways that you can set them up easily, or what's the most common way? Or
so in terms of, once a trust is set up, then the next stage is to again speak to your broker or your bank.
And setting up a trust goes how? So that's to your accountant?
Yeah, just to your accountant.
Yeah.
That process is pretty quick typically. That can happen sometimes in the space of a couple of days.
Yeah.
So that's probably the easy part. You tell your accountant, hey, I want to buy a self-managed super fund property.
Yep.
And they will set that up, literally a couple of days, depending on their
availability. Yeah, that's not the long task.
No, that's the easy task.
There are a couple of long processes, and they are kind of out of our control. We have to wait for the actual SMSFs. Sorry, not the SMSFs, the superannuation trust that you might already, bludgering that one too, the actual superannuation accounts that you might have with your normal super to transfer and roll those funds over. And that takes a really long time. And that process can take upwards of, I think, around 3 months at some stages. And it's
probably gotten faster, maybe like 6 weeks, 4 to 6 weeks sometimes.
Yeah.
Little tip is doing that through MyGov.
Okay.
Because find that those government agencies then push it through. It's an official request.
How do you do it through MyGov?
So you just log in with if you've got a MyGov account, you just log in, and then it's really simple. There's just a rollover section, SMSF rollover section you go through. And it's super easy. And then they process it for you. They send it to your super fund and say, we want this rolled over. Yep. If you go directly to your super fund, they're trying to hold those funds as long as they can.
Yeah.
Sorry, we didn't get the request. Or there's always a reason.
Well, they have a timeline that they have to fulfill that order within. And obviously the longer that they hold those funds inside their account, they're earning interest on it. Yeah. So they are in no rush to transfer that money out of their funds account into your SMSF.
Yeah.
So they will take as long as they can because it's more beneficial for them. So going through the MyGov route in your app, can you do it in your app?
Yeah, you can just do it. You got a MyGov app or just log into the website with your account, and it's simple.
What's the turnaround time for that typically?
Oh, I think it said something like, don't quote me, about 14 days or 21 days. Something was much shorter than going directly to your super fund. So, and then it's obviously registered through government agency. So there's more weight on that request. The other thing is setting up the bank account. So you need to do that before you roll your funds. So some banks, say like CommBank, they'll make you go into the bank with all your trust documents. If you go through some other banks, say like Macquarie, you can actually set that up online. It's still a little bit of a process, but you've obviously got to create the bank account before you can roll the funds over.
Yeah, and as time goes by, other banks will start to become a little bit more lenient to it.
Correct.
So just keep your eyes on those banks that what going to benefit you more and serve to them.
Definitely. It is pretty much one of the fastest growing sectors that we're seeing as well. The amount of people are coming in wanting to buy in their self-managed super funds.
Yeah.
There's a couple of things people do need to be wary of. Firstly, you can't redraw the equity. If you buy a property in your self-managed super fund, it grows. You can't redraw that equity and use that as deposit for your next property. So it's all locked in there. Yeah. Secondly, principal and interest only. So you can't do interest only. You can only do a principal and interest loan. So essentially your payments are quite a bit higher there as well. Yeah. That's why a lot of accountants are going to say, maybe have a bit of a higher balance to start with, maybe that 150 to 250 to start with, just so it's not as big of a loan, because if you're paying principal and interest, the repayments are going to be much higher. Yeah. And the other thing as well, you can't do renovations. You can't add value. You can just do repairs and restorations, no renovations. So you can't add value. You can repair, but you can't go in there and obviously do developments and all that within your self-managed super fund.
Yeah. Actually, you just touched on the repayments there. So with the repayments being higher because they are P&I, we know that typically and historically, the deposit size of a SMSF, what was the requirement previously? I know that it's become more relaxed recently for the deposit size of an SMSF.
So it used to be 20%. Yep. Now you can drop down to 10%.
Yeah.
You just probably want to make sure if you drop into 10% that your income or your super contributions are higher. So if you drop into 10%, you probably want to be a higher income earner. That makes a lot more sense.
Yeah.
If you're, middle range or you're in 100K, then it might be a little bit, you've got to work out the repayments and compared to what you're putting in.
Exactly. And that's again, whether you put a smaller deposit in and you've got your P&I on top of that as well, you're going to have bigger repayments inside the SMSF. So it's understanding essentially how much your SMSF is collecting from the beneficiaries essentially inside that trust each fortnight, quarter typically, and making sure that you buy the asset that's going to be supported by those repayments that are coming in.
I mean, what I love about that is that it can be a really affordable investment, because if you've got two incomes and you're putting your super funds together, and then you've got two people contributing
towards it makes sense.
And then it doesn't impact your day-to-day life. So, those repayments are coming from your super. So, I often think of scenarios where, imagine you're especially with the cost of living, imagine if you're a young family in your 40s, early 40s, you've got a couple of kids, trying to save for a deposit is going to be extremely challenging. Yeah. And this is one of those ways where you can get into the property market without impacting your life and your lifestyle. So
it's a positive for sure. It's a really good opportunity for people to get into them, especially through partnerships and couples. What other sort of benefits are there that you guys are seeing out there?
Well, we do tell people, and it's the biggest benefit by far, it's the ability to leverage. So essentially, if you've got $100,000 in your super and you make 10% on that, you made 10 grand. You take that same $100,000, set up a self-managed super fund.
This is in comparison to a typical superannuation fund. Yeah,
absolutely. So if you take the same $100,000, set up a self-managed super fund, take out another $400,000 loan to acquire a $500,000 asset. Yeah. Now you're making 10% on 500 grand. So you've invested the same amount of money, 100 grand in each. One's making you $10,000, the other one's making you $50,000, 5 times the return on the same percentage increase. And that's the great thing about property, but especially if you can do that in your self-managed super fund, it multiplies your cash on cash return much, much, much quicker.
Yeah. Another thing that is often not even thought about really, because property is the long-term hold game, right? So you buy a property, you wait for it to go up in value, and then you essentially use that equity to buy again. We'll touch on the equity not being extracted. I think we already have. Yeah. But the other side of it is that you actually can still sell a property that is inside your SMSF. Yeah. And the benefits around doing that is that the CGT, or the capital gains tax, off a property from an SMSF purchase is drastically lower. I think it only sits at 15% or something like that from your from the actual profits that are earned. Yeah. So, I mean, it does make sense that if you are an aggressive investor and you are choosing the route to go into an SMSF purchase, that you place your markets, you place your property into the right markets that will support that aggressive strategy of buying, letting it go up in value, selling it, and then using that to then buy again. However, the rule states that all the money that happens inside the SMSF need to remain within the SMSF. So if there's profits inside there that are accumulated or result from that sale, those profits need to stay inside the SMSF. They can go to property, they can go to other different types of investments, but essentially they have to stay inside the SMSF, as does the rent.
Yes.
Yeah.
Correct.
Yeah, definitely. I guess in regards to price points, we're buying between about 450 to about 900 a daily basis. Would you recommend, obviously you're in the trenches all day, obviously finding these properties for a self-managed super fund, what would you recommend price point to start at?
That's a good question.
I like this one.
That's a really good question.
Put it into the markets framework as well, I think.
I think what's important is working out your strategy. I've heard some stories. We actually had one the other day where we're actually doing an interview, and the interviewee was telling us how they were managing hotel chain or something.
Oh, yes.
And those rooms were being sold, and the cash flow was great, right? It was like 12% deposit. But from an and he said, you know, that there's
entirely wrong strategy.
All these,
no offense.
SMSF purchases, and they thought it was great because the yield was great. But that actually, I mean, each their own, but at the same time, it's probably not the greatest investment for your super. So it's just really about understanding what you're looking for. And I'd imagine that, you know, it's the growth that you really want, that cash flow. That's not going to grow. That asset is not going to grow.
I feel like maybe off a sustainability standpoint, that strategy could potentially work. But if you're prioritizing cash flow and essentially it's because you don't make a good income and you do need that SMSF to support itself, potentially that could be a strategy, but you're sacrificing it for the greater return, which is equity and capital gain. Well, I'm assuming that this is the case essentially. If that's not the case, then I could be entirely wrong, and maybe they both do extremely well returns on capital gain and cash return. But I would imagine that, and we know that being in the economic landscape of property investing, you either get one or the other higher than either or. And it is very difficult to get both. And so we also know that the assets that we were speaking about were one bedroom, like studio apartment types of things. We know that there's no demand for that. So the equity gain off that is pretty much non-existent.
And when you want to sell, that's only going to be sold over to an investor. Like an owner-occupier's not looking to buy that. So you're limiting your resale market, essentially, is what you're doing. But going back to your point, it's like if you had, you'd probably spend a bit more, but let's just use 100,000 because it's easier. But if you threw down 100,000 and you leveraged into a 500K property and you were able to hold that property for 20 years and you look at the national average and say property doubled, let's just say every 10 years, you know, you're going to, that property is going to go from, you've invested 100K at 500, in 10 years, that 500 is worth $1 million. 10 years after that, it's worth 2 million. And all you've put down is 100,000.
20x return.
And imagine, you know, that's where you're going to get to your retirement phase and stage where you hopefully be able to have a great retirement, be able to do the things you want to do.
And at that point, when you do sell, you actually pay no capital gains tax because you're retired.
Correct.
And that's another benefit again.
Correct.
So yeah, there's quite a few beautiful points about SMSF. Are there any other hot topics that you would think about? In fact, I've got one for you guys. Where would you buy if you were purchasing an SMSF property? Now, I guess it comes down to, again, the structure and the strategy that you're going for in the play. But why don't you guys break that down?
So I guess it is that finding the right balance. So ideally, we are telling people if you can get as close to the metro as possible, that's obviously it's just got that perception that if you're holding for a longer term. However, you have to realize in Australia, there's only really, 4 major cities. A lot of our regional areas are actually quite big. They're getting huge amounts of growth and they're expanding quite rapidly. A lot of people are moving out of cities, especially now with the world way the world's heading, people are starting to work more remotely as well. We're starting to find some really, really good deals out in the regional areas. We don't touch rural. Regional areas got to have at least 4 key economic drivers, obviously the master of regional. What about yourself? What are you finding as well?
Well, master of regional, I like that. I'll take it. Look, I mean, I'm all for metro obviously as well. And I do know that there's a big safety conception around, metropolitan being familiar, and familiarity holds trust. So yes, major metropolitans are always going to be a good area to buy in. Well, not always. Actually, not always. Yeah. It has to be understood around the data. But when you look at it from a regional perspective, there is so much population growth and expectation of CGT, and so much expectation around GDP, and the GRP is increasing. And the GRP is the gross regional produce. And that's because the population that is moving inside Australia at the moment is looking for new and affordable areas to live in, because we've just gone through a massive growth cycle. And that growth cycle has forced people to look for, I don't want to say survival, but better opportunities essentially. And these exactly. Yeah. And these opportunities are sitting in the more regional areas where there's still a large amount of economic support and diversification. If you look at Townsville, for example, major. It's regional, but it's major. And it's got so many different economics that are supporting it, and so many different industries that are supporting those sectors of employment. And as long as you can find an area which has got a somewhat cyclical cycle of economic return inside it, where a gentrification quality is coming up, it pushes the population into a new market. That new market then pushes a new property market into another market. Yeah. And so this continues. This essentially, from a perspective of how property economics works, you really just need to have enough diversification inside an area. Whether it's metro, whether it's regional, it's not all that important. You just have to have the confidence that the salaries are going to be supported for a long time ahead because of the diversification of employment and economies inside them.
Yes.
To me, SMSF can sit in regional, it can sit in metropolitan. Regional can have a better outcome, metropolitan can have a better outcome. It really does depend on what's happening economically.
Yeah, definitely. Agree. Every suburb's on a different property cycle. There's no such thing as the Australian property market.
100%. Not even the Queensland property market or the New South Wales or the Victorian. Those are states and territories.
Yeah.
There are granulations of this.
100%.
Try not to get into, typically I call it like a FOMO market where you've seen it, do X amount of growth and you're diving in. Just, do your research.
Yeah.
Look into those things that you were just talking about. And but that's where that strategy comes in. So, no investment is without risk. So, when you're going to put your super money into an investment, just make sure you've looked into it and you've got that strategy, and seek advice from professionals. And look into that type of stuff, because it is a big decision to use those funds. It is your retirement money, so you do want to get it right, but do your research.
Yeah. With the SMSF, are there any other little hot tips and tricks that you guys got left before we wrap this one up?
That's pretty much it for me, man.
Okay, well, I can't end off with that then. Nope. Well, great, guys. Thanks. I mean, I think we've covered quite a bit there. I think it's important for people to understand that there's another tool out there that if they cannot invest personally, there is another opportunity to potentially do it as a couple under a safe trust structure like an SMSF, and that these are opportunities that can put you into a really good strategic play against, even if you do have your existing portfolio, it's something to complement that portfolio. And essentially it's a tool that we can use to get to our retirement goals and take advantage of that. And along the way, be strategic, reach out to the professionals that can help you, make sure you understand a little bit more about those SMSF structures so that you're educated around the things you can't do, and play towards that, because like any toolbox, there's another tool in that box. And SMSF is just the same. Guys, thanks very much for all your wise words on today's podcast of the Lazy Equity, all about self-managed super funds.
I appreciate it. It's been good.
Yeah, I think it was quite educational.
Excellent. Good. Thanks, guys. Join us next time for another episode of Lazy Equity. Make sure you like and subscribe to get updates of those next releases.